We are going to look at a question on consolidation with a wholly owned subsidiary. In any consolidation question, the first thing that you should look for is the date. So if you look at the beginning of the question, you can see that the acquisition happened in 2014. And then you should look at the end of the questions to look at which is the dates that they want you to prepare consolidation entries. If you look at the requirement, it says that they want you to prepare the consolidation journal entry for 2017. So what that tells you is that this is 3 years later. The date is important because depending on how many years later that they want you to prepare journals, it's going to affect a number of entries later. So in this one, we know that it's going to be 3 years later. Okay, after that, we then start from the beginning of the question and start with acquisition analysis. So as you all know, the acquisition analysis is to compare the price that you pay with the fair value that you get in return. So looking at the beginning of the question, Cow Limited acquire 100% of the share capital. So we have this word here called cum dividend. Cum dividend means that the parent is going to receive the dividend from the subsidiary. But interestingly, you can look at the question after that, there is no dividend here. So why is that? Because that information is hidden somewhere else, which we'll cover that a little bit later. So after that, you can see that they pay for $500,000, and then right here we can see that we got capital, reserve, and retained earning. And before you write down the acquisition analysis, there are some other information that you need, because you need to make sure that everything is measured as fair value. So the next block of information, they are telling you what are the fair value adjustments. So right here, we got the adjustment for inventory as well as land. And you also need to look a little bit further to see whether there's any other assets and liabilities that they want you to revalue. As you can see that here, in this paragraph, we also got a patent as well. And the fair value was $25,000. And you also need to include that in your acquisition analysis. Okay, so let's write down the information here. So we're going to write down acquisition analysis. So we're going to start with the net fair value of identifiable net asset. So with this one, we want to add up all the pre-acquisition equity. So according to the question, we got 300,000 capital, 30,000 general reserve, and then 90,000 return earning. For myself, I tend to write down the name of those equity because it's going to help me to prepare some journals later on. Okay, on top of that, we also need to include the fair value adjustment. So as you can see that in this question, we got inventory, land, as well as patents that we need to include in our analysis. So right here, we're going to write down inventory. Remember, all of them need to be after tax. I'm also going to write down this is inventory. We have land, that's 15,000 above. And finally, we also got patents, which is 25,000. Okay, that will be all the acquisition analysis in terms of the net fair value. If we add up all the numbers together, you will see that the net fair value would be $452,900. And what you want to do is to compare the net fair value that you acquire with the price that you actually pay. If we go back to the beginning of the question, you can see that Cow Limited paid $500,000. But at the same time, you can also see that it is cum dividend. So you need to find out exactly how much dividend did they receive. How do you know that without getting the information from the beginning of the question? What you need to do is to look up the financial statement. Because if Cow Limited received any dividend from the subsidiary at the time of acquisition, that amount of dividend would be deducted from the cost of the acquisition. What I mean by that is if you look at investment in Russell Limited on the balance sheet, you will notice that the amount is only $490,000, which is $10,000 less than the $500,000 that you have at the beginning. And the only reason that you have less is because you have received the pre-acquisition dividend from the subsidiary. So as a result, the $490,000 is the amount that you want to include in your acquisition analysis. So we're going to write down consideration, and there is 490,000. And the final step of the acquisition analysis is to compare that with the net fair value. As you can see that the consideration is higher than the fair value. As a result, we're going to have a goodwill of 37,100. Acquisition analysis is important because a lot of this information will be used for the journals a little bit later. So I would suggest you to make it as clear as possible so you can save some time later. So after that, we are going to start preparing journals. So the first group of journals that we need to prepare would be the business combination valuation entries, BCVR entries. As you know, the purpose of this group of entries is to revalue the asset from the carry amount to the fair value. So what you can see from the acquisition analysis is that we have three assets up there that we want to revalue: inventory, land, and patents. We also got goodwill as well, which we also want to recognize on BCVR entry. So the challenge for you is to identify which assets here do we need to adjust the fair value, because as you know, this is 3 years later after the acquisition. So we're going to look back to the information to see whether we need to recognize the fair value again after 3 years. So what you can see here is that after the information about fair value, it says that all inventory was sold by 2015. Right now it's already 2017, which means that you no longer have the inventory. As a result, there's no need to adjust the fair value. Then if you look at the next sentence, you can see that Russell Limited revalued the land to fair value immediately after the acquisition. Remember, BCVR entry is to adjust carry amount to the fair value. But if the subsidiary already revalued the asset, there's no need for the parents to do the revaluation again, which means that you also don't have any journal for land as well. Finally, with the patents, you can see that they have 25,000 value, and then they got a 5 years of useful life. So we need to recognize patents under BCVR entry. Okay, let's write it down. BCVR entries. First of all, there will be no entry for inventory and land. Okay, no entry for inventory and land because we sold the inventory, we also revalued the land as well. But we are going to have an entry for patents. So for patents, they didn't recognize it. We need to recognize that for $25,000. So what we want to do is to look at the value of patents. In this one, we got $25,000. So we got debit patents for $25,000. Okay, after that, we also need to recognize the credit side as well. 30% of that will become DTL, and then 70% of that will become BCVR. So that will be the original journal to revalue patents. After that, you can also see that from the question, we got 5 years of useful life. And now it has been 3 years. So we did 5 years of useful life, which means that per year, it's going to have 5,000 amortization because it's an intangible asset. And it has been 3 years. So in the current year, we are going to recognize $5,000 amortization expense. And then the prior 2 years, we are going to recognize retained earning. Okay, because we need to carry forward the amortization expense and that will reduce retained earning. Which means that we have accumulated amortization of $15,000. After you recognize that 3 years of amortization, you also need to reverse 3 years of deferred tax. So what we need to do is to debit DTL. 3 years of that, we need to multiply 15,000 by 30%. So you are going to get 4,500. And we also need to reverse the income tax expense as well as retained earning. So it's going to be 1,500 and then 3,000. So that will be the journal for patents. So if we go back to the acquisition analysis, as you can see that we have already taken care of inventory, land, as well as patents. The final thing we need to take care of is goodwill, because goodwill is also a new asset that we want to recognize. So according to the question, goodwill, we got $37,100. So we're going to debit goodwill, and then we want to credit BCVR because there's no deferred tax for goodwill. Okay, that will be the journal. As you can see that from patents, there is an amortization. There is no depreciation or amortization for goodwill. However, you also need to check whether there's any impairment of goodwill. So we're going to go back to the original question. Let's look at the additional information. What you can see here is that additional information F is also about goodwill. And you can see that there's a goodwill impairment of $2,000 and $3,000. So as you can see that there's two separate amounts. So the key for you is to look at the period. Which one is the current year? Which one is the prior year? As you can see that the 2017 is current year. That means $3,000 will be current year. And then you got 2016 of $2,000, which means that you got 2,000 from the prior year. So let's come back to this. We're going to have goodwill impairment. So goodwill impairment expense is a current year is 3,000. And then prior year, we're going to use retained earning. That's going to be 2,000. And then in total, we got the accumulated goodwill impairment for 5,000. So that will be the journal for goodwill. So that will be the end of BCVR entry. The next group of journal entry will be pre-acquisition entries. The purpose of the pre-acquisition entries is to eliminate the pre-acquisition equity against the investment in subsidiary. Okay, let's write down pre-acquisition entry. So with pre-acquisition entry, we got the main journal and also some additional journal. So as I said, the main journal is to eliminate the pre-acquisition equity against the investment in subsidiary. We'll deal with the easy one first. Investment in subsidiary, remember, we are looking at 3 years later. So we want to use the 490,000 for 3 years later. So with this journal, we're going to credit investment in subsidiary. So in this way, it's Russell for 490,000. Okay, then we need to offset against all the pre-acquisition equity. The easiest way is to look at the information from your acquisition analysis because you already got those information. What you can see right here, you have these three amounts of pre-acquisition equity. All of those need to be included in your pre-acquisition entry on the debit side. So we're going to debit capital, $300,000, reserve, 30, retained earning, 90,000. Okay, that will be the three amounts. But as you can see that doesn't equals to 490,000 because we also have revaluation as well. And with revaluation, you got to be quite careful with this one because if we go back to acquisition analysis, what you can see is that we have inventory, land, patents, and goodwill. However, we also know that land, we have already changed it into fair value. That means land will become asset revaluation surplus. This is very important because if the subsidiary already revalue the asset, then the parents on the group don't need to recognize any BCVR for that anymore. So we're going to write it down first. With land, 15,000 after tax is going to have $10,500. We're going to debit ARS 10,500. To make that very clear for you, this one is about land. After that, we also got BCVR. And the BCVR will be about inventory, patents, and also goodwill. It's going to be all of them. And how do we actually make the calculation is very straightforward. All we need to do is to calculate inventory, and then we also calculate patents, and then calculate goodwill. And remember, inventory and patents, it has to be after tax, and then goodwill will just add up 37,100. So as a result, if you add up the total, you're going to have 59,500. In a long journal, it's very important that you add up the debit and compare that with the credit to see whether you're able to balance the journal. So for this one, if you make a calculation, you will notice that you're able to balance the journal, which means that it's probably correct. Okay, what are the other journals that we need to recognize? With this one, we need to know what happened with the assets. With land, you have already revalued that. There's no further journal. But with inventory, as you remember, we sold the inventory 1 year after acquisition, which is not in the current year. As a result, we need to reverse the BCVR for the inventory. So we go to debit, retained earning, and then credit BCVR. And then specifically, this one is about inventory. And the calculation would be $7,000 after tax, which means the amount would be $4,900. That will be for the inventory. After that, there are other adjustments that you might want to make. For example, what happened with general reserve then? Is there any change? Let's go back to the question. What you can see here is that at the beginning, the subsidiary has 30,000 general reserve. This is 3 years later. Let's take a look at the general reserve now. It's actually 75,000, which means that there has been an increase in general reserve. But does it mean that we need a journal under pre-acquisition entries? Remember, we are preparing pre-acquisition. So we need to make sure that the increase in general reserve is actually coming from the pre, not post. How do we know? We actually have this information in additional information. If you take a look at additional information E, you can see that all transfer from retained earnings to the general reserve by Russell Limited were from post-acquisition earnings. It's all from post, not pre. Right now, we are preparing pre-acquisition entry. As a result, we are not going to have any journal about general reserve under this section. If you prepare a journal, that will be incorrect. Okay, now we can move on to intragroup. With intragroup transactions, there are always a number of typical types. For example, you got dividend, inventory, non-current asset, loan and interest. So you need to actively look for those information in the original question. And the one that I always like to look at is dividend first. First of all, dividend, you will see that in pretty much every single consolidation question. And secondly, that information normally comes from the financial statement. Let's go back to the original question. You can see that there's no information about dividend on the first page. But then after that, you can also see that there is dividend on the financial statement. Remember, we are only interested in the dividend paid or declared by the subsidiary, not the parent. What you can see here is that we have 22,000 declared by the subsidiary. This is important. If it's declared, it means that it hasn't been paid yet. So here, that 22,000, this is a wholly owned subsidiary. As a result, the entire 22,000 will be paid to the parent entity. So we're going to write down this journal. We're going to debit dividend revenue for 22,000. And then we're going to credit dividend declared for 22,000. And because it is a declared dividend, we also need to recognize the payable and receivable. So that will be the journal for declared dividend. So that will be the first one that I do. After that, I would then follow the order of the additional information from the question. And then we'll go work through one by one of individual intragroup transaction. Additional information A, you can see that we got a sale of inventory. And when you see a sale of inventory, before you look at any numbers, you need to first identify whether it is a current year or prior year transaction, because it's going to have a direct impact on the format of your journal. What you can see here is that it is during 2015 and 16, and this is a prior year. Okay, if it's a prior year, there's no need for you to eliminate any more revenue. Instead, you need to eliminate the unrealized profit carried forward from a prior year. Let's look at the rest of the information. You can see that they bought it for 20,000 and then the original cost is 14,000. That means you are going to get 6,000 as the profit. But then after that, you also can see that a quarter of this inventory was sold by Russell Limited to external parties by the end of that particular year. And the rest of that is sold in the current year. Okay, what do we need to do here? We first write down the formats of the journal first, and then we've got to work out the individual number. Because this is a prior year transaction, and they are all realized in the current year, the format of the journal will be debit retained earning, debit income tax expense, and then credit cost of sales. So that will be the format of the journal. With retained earning and income tax expense, the key there is to eliminate the after-tax unrealized profit. And how much is that exactly? As you calculate earlier, you got $6,000, which would be the original profit. But it also says that a quarter of those were sold in that particular year. That means the rest of that, the 3 quarters, will be carried forward to the next year. And that next year is the current year that we're talking about. So right here, you can see that we want to carry forward $4,500. Okay? And $4,500 after tax is going to be $3,150. So that will be the 70% of that. And then the remaining 30% would be income tax expense. And then we're going to credit cost of sales with the same amount. So with any prior year sales of inventory, the key is to look at the amount of unrealized profit. Once you have that, you can then complete the journal. So there will be the prior year sales of inventory. If we continue with additional information B, is also a sales of inventory, but this time it's going to be a current year one. How do I know? Because it says that it's 2016 to 17. So this one is a current year. With a current year one, we need to eliminate both the revenue as well as the unrealized profit. So right here you can see that they sold that for $25,000, which is the original revenue, at a markup of 25%. We're going to use this information later. By the end of the year, Carl still held inventory that he had bought from Russell for $12,000. That's all the numbers that we have. We are going to use this number to eliminate both the revenue as well as the unrealized profit. So this is the current year sales of inventory. So we are going to debit sales revenue, credit cost of sales, and then credit inventory. Based on the question, the original sales was $25,000. We don't care about what happened after. The original sales always need to be eliminated. So there's no problem. The key is to work out the unrealized profit, because that will be the amount that we need for credit inventory. In order to calculate the unrealized profit, we need to first calculate the profit first. Right now, the only information that you have is that they have a markup of 25%. So as you all know that if you got a cost, multiplied by 1 plus the markup is equals to the revenue. Right now, we have 25,000 revenue and then 25% of markup. So if you use 25,000 divided by 1.25, you'll find out that the cost is going to be 20,000. And this is an important information because after we compare the cost and the revenue, we'll notice that the profit of that transaction would be $5,000. That would be the original profit. But we are interested in unrealized profit. Unrealized profit is to find out how much of this inventory is still on hand. And based on the question, it says that 12,000 of that inventory is still on hand. But that's not a percentage. You need a fraction or a percentage to work out how much of those inventory is still on hand. So you're going to divide it by the 25,000. This is the inventory on hand. Because 25,000 is the original value of the inventory that's bought by the buyer. So we got 5,000 multiplied by 12,000 divided by 25,000. You'll work out that the amount of unrealized profit equals to 2,400. And that's the key information. Because now we'll know that the credit is going to be 2,400. And then we work backward and you'll find out that the cost of sales will be $22,600. So the key for any sales of current year of inventory is to work out the unrealized profit. That will be the credit entry. After that, we also got the deferred tax as well. We're going to use 2400 multiplied by 30%, and you will see that DTA would be 720. Okay, the next one would be sales of non-current asset. If we look at additional information C, it says that Russell sold an item of equipment for $32,000. So this is a sale of equipment. Again, very importantly, need to look at the dates. As you can see that 2016 April, which is more than a year away from the current year end. And with any sales of equipment, because we need to calculate depreciation later, you need to have a precise date to look at how far it is from the current year end. What you can see there is April. That means it's 1.25 years away from the current year. And we need this information to calculate the depreciation later. Okay, after that, once again, we need the information for the sale price and also the original cost. So we got the sale price that's $32,000. The carry amount at the time is $26,000. And then we got $38,000 for the original cost. Also, we got a depreciation rate of 20%. So how do we approach this? With sales of non-current assets, we first need to eliminate the unrealized profit. So we're going to debit retained earning and also debit DTA. We debit DTA because they haven't sold the equipment to external party. That's why we still got the deferred tax. How do we calculate this amount? It's very simple. So what we can see here is that we got $32,000 as the proceed. We want to minus the carrying amount at the time of sale, which is 26. As a result, the unrealized profit would be $6,000. 70% of this amount would be retained earning, so it's 4,200. And then 1,800 would be the DTA. Okay, that will be for the unrealized profit. Then the step after that, we want to reinstate or restore the original cost. Okay, how do we do that? We're going to debit equipment. And we want to compare the carry amount, not the sales, to the original cost. So right now, we have $32,000, which is the sale price. And then we want to adjust to 38, which is the original cost. As you can see that there's an increase of $6,000. The final part of that is to credit accumulated depreciation. We need to reinstate or restore the original accumulated depreciation. So with that amount, we want to compare 38,000 to 26,000. Because the difference there would be the original accumulated depreciation. So we'll have $12,000 for that accumulated depreciation. So that's all in terms of this particular journal. So when you sell non-current asset from the prior year, you first need to eliminate the unrealized profit. Secondly, you need to reinstate the original costs. Finally, you need to reinstate the accumulated depreciation. And because this is a depreciable asset, we also need to adjust the depreciation as well. Because right now, the value recognized by the group will be lower. So we want to reverse some of the depreciation. We also say that we got 1.25 year of depreciation that we want to adjust, counting backward from the current year dates. That means we got a whole year of current year and a quarter of the year in the prior year. So what do we need to do? So what we need to do here is to calculate the amounts of depreciation. And the amount of depreciation, the difference was $6,000. 20% depreciation rate, that means we divide it by 5. It's going to be $1,200 per annum. But at the same time, you also need the quarter of the year as well. So for a quarter of a year, is going to be 300. So that's the information that you need. After that, we want to reverse the accumulated depreciation for the whole 1 year and a quarter. 1 year is 1200, a quarter of a year is 300. We got 1500 in total. And then in the prior year, it's going to have 300, and then depreciation is going to be for the current year, which is 1200. And on top of that, we also need to reverse the deferred tax as well. So we are going to debit retained earning, debit income tax expense, and then credit DTA. Again, all of that is going to be 30% of your previous journals. So we're going to have 90 here, 360, and then 450. So the key for any prior year depreciation is to work out exactly how many years do we need to recognize. And sometimes it might be less than that 1 year. For this one, we're going to have 1.25 years. So that will be the sales of non-current asset. Let's look for any other information. They say that for additional information D, we got interest, 5% per annum. If you got an interest, it means that there's a loan. But in this information, there's no information about loan, which means that you need to look for that information on the financial statement. So for the financial statement, what you can see here is that we got loan from Russell, which is $40,000. This loan from Russell is a liability. At the same time, we also got a loan to Kyle, which is an asset, also for $40,000. So in order to eliminate the interest, we first need to eliminate the intra-group loan, and then using that loan amount to calculate the interest. So we are going to debit loan from Russell, which is a liability. We want to eliminate the liability. And then we also need to credit the asset, loan to Kyle, also for $40,000. So that will be the original amount of loan. After that, we also need to calculate the interest. The interest is 5%. 40,000 times 5%, that's 2,000. And based on that information, that interest had been paid by the end of the year. So you only need to eliminate the revenue of that interest. So we're going to debit interest revenue and then credit interest expense. And I think that we have covered all the intra-group transactions. It's very important that you are familiar with the types of intra-group transactions and then actively look for that in the question.